All right, folks, I've had several people request this video for quite a while now, and with the severe drought that we've experienced this summer, I thought that this would be an appropriate time to make this video, just to tell you all about how crop insurance works. Now, first of all, I want to preface this by saying a few things. Crop insurance is a tool that we use to minimize our risk when we experience adverse conditions or low yield. It is not something that any farmer worth his salt wants to make a profit on. None of us want to be insurance farmers, but we have insurance to protect against the inevitable. Same reason you got car insurance and homeowners insurance and everything else, because bad things can and do happen. And it's the same way in farming. There's a lot of things that are unpredictable, things that we can't control that can affect our income year in and year out. And since we basically only get paid once a year, any loss of income can have long-lasting effects on us, and crop insurance is a good tool to minimize that risk. Most farmers, they always strive to make the best crops, best yields, best quality crops that they can, but inevitably something's going to happen in a year where on something that we can't control and could cause us a crop loss. Also, something else that people might not know is that crop insurance is federally subsidized. And the level that it's subsidized at just kind of depends on what level that you choose. Now, I'll speak more of this later on in the video. Also, crop insurance rates are set by the federal government, so there's really no reason to shop around different companies that provide crop insurance, because the rate that you're going to get quoted is going to be the same because it's set by the federal government. When a farmer chooses crop insurance, it's more important to choose a crop insurance company or agent that they trust, that they know that will get any kind of claims turned in quickly, that will work with them real closely to choose the best type of coverage that is best for their operation and their financial situation. Those are the main considerations that we choose when choosing a company, because it doesn't pay to shop around because the rates are going to be the same. Now, this video is going to deal with how crop insurance works on your major commodities: corn, cotton, soybeans, and wheat. I can't speak about any other crops, specialty crops, or livestock, or anything like that. I'm sure that there's insurance available for that, but considering we're just row crop farmers, I don't know how that works, so I'm not going to talk about that. So for the purpose of this video, we're talking about our major row crop commodities. Before we get started into the nitty-gritty, there's basically 4 factors that come into play when determining whether a farmer is going to have a claim at the end of the year. First, you've got your production history. What your historical production has been on that farm kind of sets the level at what you can be insured at. Then you've also got the price of that commodity for that year, because commodity prices are constantly changing, going both up or down. Each year has its own commodity price that determines what the value of that commodity is. The third thing is what level that you decide you're going to get insured at. There's many different levels, ranging from not as much coverage and having a lower premium to having a lot higher coverage but having a very high premium. So which one of those levels you choose can determine whether you get paid out or not. And then fourth, of course, do you have a lower yield for that year? Are you experiencing any kind of loss? So it's those 4 things that come into play when determining whether you're actually going to draw any kind of crop insurance money for the year. Let's start off with the first factor, your yield history on the farm. Your yield history is what is used to determine what your farms are capable of producing for an average, and then that's used to determine whether you've actually got a loss in a year or not. Now, every year after harvest, farmers were required to report their yields to the crop insurance company so they can keep a database of the yield history on your farm. And when calculating what your guaranteed yield is for a farm, crop insurance takes 10 years worth of previous crop history in order to build that average. Now normally, I mean, that sounds fine and above itself. Where we get into a problem with this is farmers who rotate, you know, say they're a corn and soybean farmer. Well, they only plant corn on their farm every other year. So to get 10 years worth of corn crop history on a farm, you have to go 20 years back into the past. Now yields typically go up on a trend line every single year as varieties get better, farming practices get better, as we improve our soils and a lot of other things. You know, crops tend to gradually follow a trend line up. So if you go back 20 years in the past, corn yields, soybean yields, cotton yields were a lot lower 20 years ago, but you've got yields from those years figuring into your average. So while you might have a farm that's, say, capable of producing 200 bushels per acre of corn right now, you know, that same farm might have only been producing, say, 150 to 160 bushels of corn 20 years ago. So you got those averages figuring into your average yield. And then you take the average of that 10 years, it's going to be lower than what that farm is capable of producing now because of where we are with farming technology and advances in varieties and everything else. So while your farm might be capable of producing 200 bushels per acre of corn now, that's not what you're going to be guaranteed, and then anything below 200 bushels per acre you're going to be paid for. That's not the way it works, unfortunately. Now, looking at my case, this factor comes into play even more because we rotate our crops once every 3 years because we have cotton in the mix. We grow, our rotation is corn, cotton, and then wheat and double crop soybeans. So we only get corn or cotton or wheat or double crop soybeans planted on a farm once every 3 years. So technically we could have production from 30 years ago figuring into our average, which would cause our average yields to be even lower. Now looking at this one farm right here, you look right here, you know, we've got our 10 years worth of yield production. This is a farm that we own and we've owned for a long time. It's also a large farm with 3 tracts of land, so typically we've got one of each crop growing on that farm number every single year. So we might have cotton on one tract of that farm number, might have corn on another tract of that farm number, and then wheat and double crop soybeans on the 3rd tract of that farm number. So in order to get our 10 years worth of yield production history, we only have to go back 10 years in the past. You can see right here, you know, we've got our crop years that we produce cotton on this farm. We got the total production of each year for that farm. We got the amount of acres that we planted that year, and then finally we've got our yield. Then all of this is used to calculate our average yield. Now crop insurance has come up with a way to help mitigate these lower yields in the past. It's trying to take the advances in genetics and crop practices, is trying to take those factors out and assume that every year is going to be equal. And the tool that they use for doing that is what's called trend adjust. Now this trend adjust is another option we can choose on our crop insurance, but it does come at a cost. We have to pay extra for it. So if you look right here, crop year 2011, our farthest year back in our yield history, you know, we actually yielded 785 pounds per acre. You know, not great, but 785 pounds an acre was better 10 years ago than what we would consider it now. Now, if you factor in the trend adjustment right here in this column, you can see that brings our yield for that year from 785 pounds an acre up to 925 pounds per acre, which is a lot more acceptable. And then as we go down, the yield gap between our actual yield and trend adjustment yield goes down because we're getting closer to the future. You say, now look at last year's production, 2021. Now we had a real bad year of cotton last year. We came up with 619 pounds per acre on that farm, but our trend adjust yield only rises it to 632 pounds per acre. So if you got fairly consistent yields for the past 10 years, the trend adjust option might not really make that much sense to you. But if you're steadily rising in yields, the trend, like in our case, the trend adjust option becomes a very valuable tool, and I found that it's worth the money. So now your question might be, I just picked up a farm. I don't have any kind of yield history on it. How do they determine what my approved yield is. All right, in this example right here, this is a farm that we bought back in 2018 and we had no yield history on it, and we first planted corn on it in 2020. In the case of crop insurance, you need a minimum of 4 years worth of history to have an approved yield, but if you've never planted a crop on that farm, of course you don't have any yield history. So what crop insurance does is they take what they call a T yield and plug it in for 4 years worth of production, and the T yield is the county average for that crop. And in this case, the T yield for Crockett County is 146 bushels per acre. Now, if you look at this farm right here, we had corn on it in 2020, and we had a production of 170 bushels per acre, which is significantly above the county average. And the majority of farmers that are good, they're going to be producing yields that are higher than the county average. And I understand that we got to plug something in to get some kind of idea of a yield average, but when you're consistently producing above the county average, but you're using the county average for your average yield and approved yield, then this comes to where it hurts you, and crop insurance is not going to be near as beneficial for you. Now, my crop insurance agent did tell me what crop insurance is supposed to do is they're supposed to either plug in the T yield or plug in what your simple average is for that county. Now, I haven't worked the numbers to find out if that's in fact the case or not, but it doesn't appear to be that way on this example right here. It looks like that the T yield was used, so that's something that I'm gonna have to bring up with my crop insurance agent before I have corn on this farm again. So you say we've got a farm that's capable of producing 170 bushels per acre, but our approved yield, our yield average is only 152 bushels per acre. Now, as we keep growing corn on this farm in the years to come, our approved yield should go up. As long as we're yielding above the county average, our yield should go up. Now, looking at this farm right here, this is a farm that I don't plant cotton on because the landlord doesn't want cotton planted on it. So, we rotate every other year rather than every 3 years. But right here, you see, we've got yields on these full season soybeans going back all the way to 2002. We've got an average of yield of 47 bushels per acre. Now, looking here at our actual yields, in 2002, 2003, we were making 34 bushels an acre, 39 bushels an acre, 41 bushels an acre in 2004. Then if you look later on here, as genetics have gotten better, as I've gotten better as a farmer, our yields have really gone up. 55 bushels an acre in 13, 51 bushels an acre in 16, 71 bushels an acre in 2019. Currently, this ground is capable of producing a lot more, but we've only got an average yield of 47 bushels per acre because we're going back, 20 years in the past, pulling up yield history. However, this is where the trend adjust option becomes a big benefit to us. It raises our average yield from 47 bushels an acre up to 55 bushels an acre. Still lower than what we're capable of producing now, but still significantly better. All right, now that I've explained how yield history works, let's move on to the price of the crop for any given year. Now, every year we have to sign up for crop insurance by March 15th. We have to determine our election levels and all the other options, and actually sign up by March 15th. There's no more signing up after March 15th. So one of the factors that we need to know is, how much revenue we're going to be guaranteed of every year, and a lot of this is determined by the price of that commodity for the crop. Now, corn, cotton, and soybeans, the prices of that commodity for that year is determined in the month of February. Crop insurance takes the daily price of that commodity all the way through the month of February and figures what the average price is, and then that's the price that we're guaranteed on our crop insurance. For instance, this last year, crop prices have increased significantly, and we were guaranteed a corn price of $5.90 per bushel, cotton of $1.03 per pound, soybeans $14.33 per bushel. Now, that doesn't mean that we're guaranteed to sell our commodities at that price. We're still free to sell our commodities at at whatever price that we want to. These prices are just used to figure out what our per acre revenue guarantee is able to be that year. It takes our approved yield at the election level that we choose, multiply it times the price to give us our per acre guarantee. Now, all crop insurance comes standard with what's called revenue protection. Whereas if the price of the crop falls from February until harvest, then there's also the potential for another claim. You're not only protected against yield loss, you can be protected against price loss. So take corn for example, come in February at $5.90 per bushel. Say the price of corn in this fall is $4.90 per bushel. You got $1 per bushel yield loss. So we might have just say we've got a yield guarantee of 150 bushels per acre at $5.90 per bushel, but that fall that price comes in at a price of $4.90 per bushel. We can technically make above 150 bushels per acre, but still draw a claim because the price dropped. Now the fall price is figured for the daily average in the month of October for those three commodities. Now, if the fall price comes in higher than what the spring price is, our per acre guarantee is also raised. So let's say the fall price comes in at $6.50 per bushel. So instead of having 150 bushels per acre guaranteed at $5.90 per bushel, if we have revenue protection, we're guaranteed 150 bushels an acre at $6.50 per bushel. So it kind of plays both ways. If you have a price loss for the year, you are protected. But if you have a yield loss and the price goes up, you're also protected if the price goes to the upside. All right, I've talked quite a bit about, a lot of this depends on the election level that a farmer wants to be insured at. So let's just use that approved yield of 150 bushels per acre, this random that I was throwing out there, that's your yield history on the farm. Now that doesn't mean that you're guaranteed to make 150 bushels per acre through crop insurance. What it means is that that's the yield base on where you choose your election at. For crop insurance, we can choose anywhere from 65% up to 85% coverage, which is 65 to 85% of that approved yield for the farm. Now looking at this right here, for this farm right here, we've got a 10-year history of 135 bushels per acre. That's our approved yield. So if we want to get by with as minimal cost as possible on crop insurance, we would choose to be insured at the 65% level, which that means our yield guarantee on that 135 bushels per acre comes out to 87.8 bushels per acre. If we elect the 65% level, we're only guaranteed right at 88 bushels per acre. And at the $5.90 price that we have so far, that gives us a per acre coverage guarantee of $518 per acre. Now on the flip side, if we want to spend some more money and lower our risk, and increase our guarantee, we can go down here to the 85% level. In that case, we still got the same 135 bushel per acre approved yield, but insured at the 85% level, we're then guaranteed a yield of right at 115 bushels per acre, or $677 per acre of revenue. And then of course in between that we've got 70, 75, and 80%. Now if we elect for the trend adjust, that raises our approved yield from 135 bushels per acre on this farm up to 151 bushels per acre. So at the 65% level, that increases our guarantee from 88 bushels per acre up to 98 bushels per acre. That's over a 10% increase in our guarantee. And our revenue guaranteed, it goes up from 518 bushels per acre up to almost $580 per acre. And then we go down here to the 85%. 85% of 151 bushels per acre gives us a yield guarantee of 128.4 bushels per acre. 14 bushels higher than if we didn't take the trend adjust. And it also increases our revenue guaranteed from $677 an acre up to $757 per acre. So just electing the trend option gets us $80 more per acre guaranteed. All right, now that I've talked about the different levels that a farmer can elect, let's talk about what that crop insurance actually costs, because each level has its own price. Now, I mentioned at the beginning of the video that federal crop insurance is subsidized by the federal government. Now that the amount that the crop insurance is subsidized at determines on the election level that you choose. It can range from 80% of the premium being subsidized by the federal government down to 38% of the premium being subsidized by the government. The lower the level that you elect at, more of the premium is subsidized by the government, and then the higher levels are not subsidized as much by the government. Thus, your insurance premium raises dramatically as you go up in election levels. Now, all of my farms are insured under what's called the enterprise unit. That means each farm does not stand by itself and have its own yield guarantee. What it means is that all of my farms of one certain crop in one county are all lumped together, and I have an average yield for that crop for that county based upon what my yield history is for all the farms in that county. While one farm in that county might have a yield history of 170 bushels per acre, the second farm might have a yield history of 150 bushels per acre. My county average would be 160 bushels per acre. And having all of my farms insured under the enterprise unit, it serves to drastically reduce my crop insurance premiums that I pay, because basically you're lowering the risk to the insurance company, because what happens on one farm really needs to happen on all the farms in order to draw a payment. Now, in my case, this is extremely beneficial because we farm in 2 counties in Tennessee. We farm in the far most eastern part of Crockett County and then the far most western part of Madison County. I'm not spread all the way through the county. Our farms have a radius of about 10 miles, and within one county, our farms might only have a radius of about 5 miles. So generally what happens in this area of the county is going to affect all of my farms in the same way in Madison County. Now, if I was spread all throughout Crockett County, like a lot of other farmers are in this area, you know, what happens in the western part of Crockett County, there's a good chance that the same thing's not going to happen in the eastern part of Crockett County. But if I use all my farms in that one county to get an average yield, there's a better chance of not drawing a claim if I've only got 1 or 2 farms severely damaged on the other end of the county. But then on this end of the county, those farms are yielding higher and bringing my county average up, thus drawing me to not have a claim. Now, if I was to elect optional units where each farm has its own yield history and it's judged solely on whether that farm specifically has a claim or not, my chances of drawing crop insurance would generally be higher, but it comes at a lot steeper cost. From quotes that I've gotten in the past, enterprise unit crop insurance is roughly about half as expensive as selecting optional units. And considering this will only be the 3rd year that I've drawn crop insurance since I began farming myself in 2005, the amount of money I've saved on crop insurance premiums has been significant. Because so far in my history, I've paid out more in federal crop insurance premiums than I've ever collected. I've only collected crop insurance twice. One year, I think it's 2012, I think I collected a little bit. And then in 2007, I collected, I think, about $40,000 in crop insurance payments, whereas over the course of that 17 or 18 years, you know, I've paid out a lot more in crop insurance premiums. But looking at this year, because we're located in such a small area, we had a really bad drought. Now, halfway over in the county, they caught a couple of rains that I missed. And if I was under enterprise units and had crops further on in the county, there's a chance I wouldn't collect as much crop insurance money because I would have higher yields on those farms, bringing my county average up. But because we're in such a tight area, pretty much what happened to all of my farms here in Crockett County happened to all of them in the same way in Madison County. So the yields are going to be fairly comparable. Now, all of these quotes are what's quoted for me for enterprise units. I don't have the quotes for optional units, but like I said, the cost on optional units is generally about twice the cost of enterprise units. But if you look at this one farm with an approved yield history of 135 bushels per acre at the 65% level, comes up to a cost of about $6.20 per acre. Now, this 65% level is federally subsidized at 80%. What the actual cost, what the amount of money that the insurance company actually gets for insuring a farmer at the 65% level on this one particular farm comes up to $31 per acre. Now, out of that, we're paying $6.20, and the federal government is paying the rest. Now, if we go on down to the 85% level right here, it's federally subsidized at the 38% level. And as you can see, the farmer's cost is almost $35 per acre, but the amount of money that the insurance company is getting to insure this is a little over $56 per acre. So you see, the farmer is actually paying a lot bigger share of the cost insured at the 85% level as opposed to the 65% level. Now, looking at the trend adjust option, which is on this line right here, at the 65% level, we went from being guaranteed an average of 88 bushels per acre up to 98 bushels per acre. Our cost at the 65% level only jumps from $6.20 per acre up to $8.87 per acre. So, $2.67 per acre increase in our cost for an additional $61 per acre of coverage. It makes a lot of sense. It makes a lot of sense to choose a trend adjust option when you're federally subsidized at the 80% level, and I think the 65, 70, and 75% levels are federally subsidized at the 80% level. Once you get up to 80 and 85%, that's when the subsidy levels really drop off, and you can see the raise in prices. All right, to go from 65% to 70% trend adjust, we're going from $8.87 a bushel to $11.07 per bushel. Increase of what, like $2.30 per acre. Then go from 70% to 75%, we're jumping up more. We're jumping up a little over $5 per acre. And then as the subsidy level drops from 75% to 80%, we're seeing an increase of a little over $11 per acre. Then to go from 80% to 85%, we're seeing an increase of $22 per acre as that subsidy level really drops down. Now, where I've really found the sweet spot to be to comparing our guarantee versus the cost of the insurance is somewhere around that 70 to 75% level. If we look at the 65% trend adjust option, our per acre guarantee is $579 per acre. Now, if we jump up to the 70% level, that's going from $579 an acre up to $624 per acre revenue guaranteed, which is an increase of around $44 per acre. But it's only to get an extra $44 per acre of revenue guarantee, it's only costing us around $2.30 per acre. Now, to go from 70 to 75%, we get an increase of about $45 per acre in guarantee, but it's costing us around a little over $5 per acre to get that additional $45 per acre, which is not as good of a value as jumping up from 65 to 70%. And then if we look going from 75% to 80%, we're getting close to another $45 per acre guaranteed. But of that $45, but to get that $45 a guarantee, it's going to cost us a little over $11. We got to pay over 25% of our guarantee in premium. Now, if we know we're going to draw crop insurance every year, well, then that makes sense. But if you only draw crop insurance, 3 years out of the last 17 years as we have, then it doesn't make financial sense to do that. So that's kind of why I found the 70 to 75% to be kind of the sweet spot of where I like to be insured at. It gives you the most bang for your buck. Normally I elect at the 75% level to get the maximum subsidy level, but this year, because our guaranteed price came in so much higher than normal, all crop insurance prices raised across the board, and I like to keep our crop insurance premium somewhere $10 per acre or less. So instead of doing the 75% level, I insured my crops at the 70% level this year, which is, see on this farm, gives you an average cost of $11.07 per acre. Now in the previous examples, I was just showing you the cost on one farm, but let's look at the county prices because I'm insured at the enterprise unit. And let's focus mainly on corn because, well, that's what I'm going to be claiming crop insurance this year. Now, I selected Trend Adjust at the 70% level, and my cost per acre in Crockett County is $9.56 an acre, and gives me a yield guarantee for the county of 110 bushels per acre. Now, I will be able to draw a claim if I yield less than 110 bushels per acre in Crockett County, which is going to happen. Now, what it actually is going to be, I don't know. But say my average yield for Crockett County is 70 bushels per acre, which might actually be on the high end. Crop insurance would pay me would pay me for 40 bushels per acre at $5.90 per bushel, which comes out to $236 per acre. Now, I wish I'd gone with a 75% level, and if I had done that, that would give me a yield guarantee of 118 bushels per acre, which would have brought my payment per acre up from $236 per acre up to $283 per acre, and it would have only cost me a hair over $2 more in crop insurance premium. So, hindsight's 2020. I wish I'd done this year I wish I'd done the 85%, but we had to make these elections by March 15th. And at that time, I'm planning on not drawing crop insurance. So I'm trying to minimize my costs while getting the best bang for my buck. And now if the harvest price this year comes in above $5.90, I'll get the higher of the two prices. And that means that my payment in this scenario will be more than what I just told you. But seeing as how I'm making this video in the 1st of September, the harvest price will be set in October, and I don't know what it's going to be yet. Now, last year, when we were harvesting cotton, because we had such a terrible cotton crop, I mentioned that we were going to contact our crop insurance company. And then after running the numbers with our final yields, even though we had an absolutely terrible cotton crop, we did not actually wind up drawing a payment because we were elected at the enterprise unit at 75%. We had an average yield in Madison County of 856 bushels per acre, which is not good. But our guarantee at the 75% level, Trend Adjust, was 812 pounds per acre. So while we had a bad cotton crop, it wasn't bad enough to trigger a crop insurance yield. And that goes back to the fact that we've been growing cotton longer than any other crop. We've got more yield history, especially from 20 to 30 years ago, that's figuring into our crop insurance guarantee, which means it's harder for us to draw a crop insurance payment in a bad year than it is some of our other crops that we have that our yield history is based upon on a lot more recent yields. And then looking at this year, we're definitely going to have a yield loss. There's also a chance we can have a quality loss, and insurance can help with that. Say on corn this year, not only are we going to have lower yields, we also could have quality problems with having aflatoxin in corn and not being able to sell it to the yield elevator. So I'm not exactly sure how this is going to work because this is the first time this has happened in quite a while, but I'm assuming that any bushels that test positive for aflatoxin that's coming out of the field, we won't be able to sell it, and then I would think that that's going to count against our production, because essentially since we can't sell it, we really didn't produce it. That's the kind of the way I'm assuming it's going to go. I'm still going to get clarification from my crop insurance company going forward. But I do know that once it goes into the bin, if it tests positive for aflatoxin when it comes out of the bin,
I can't be paid for that because technically aflatoxin can grow in the bin. So before we put our grain in the grain bin, we're going to test every load to see if it's positive for aflatoxin. And I've got instructions from the crop insurance company that if we have a load test positive for aflatoxin, to contact them, and then what the process is going to be after that, I'm not sure. But I will discuss this in upcoming harvest videos as that matter gets clarified for us.
Well, all of that really is a brief overview of how crop insurance works. It's incredibly complex, and the amount of things that we have to understand and look at to determine our best situation year in, year out is quite a bit. And even then, when electing for crop insurance, we're basically having to predict the kind of year that we're going to have, which is pretty much impossible. So we just try to use educated guesses based upon our yield history, what our production costs are going to be, to try and select a crop insurance option that's going to cover our cost at least. Now this year, crop insurance is going to be a really big help to us. It's going to be the tool that it's designed to be, which is to provide kind of a safety net in any given year. This year, our production costs are around $430 per acre, plus or minus, to actually put in the corn crop. Our overhead cost of owning the business to raise these crops is it's projected to be around $286 per acre, to give us a final production cost per acre of $718 per acre. That's roughly what we're going to have invested in every acre of our corn crop. Now, our crop insurance guarantee, it varies from county to county, but for Crockett County, for example, at the election level that we've signed up for, we're guaranteed 110 bushels per acre at $5.90 per bushel, gives us a guaranteed revenue of around $650 per acre. So we're still going to lose money on our corn crop, but because of crop insurance, we're not going to lose as much money as we would have. We're probably going to only have a net shortfall of around $70 per acre, as opposed to probably around $300 per acre if we didn't have crop insurance. So crop insurance is not designed for a farmer to make a profit off of. Crop insurance is designed to just provide a safety net in times of trouble, to hopefully ensure that you'll be able to at least remain in business and farm another year. So in this case, it's going to do exactly what it should have. So anyway, I know that was a lot of data to look at, a lot of numbers to look at. Crop insurance is incredibly complex and requires a lot of examination every spring and a lot of guesswork on what kind of year we're going to have going into the year, to try and choose the right crop insurance that's going to provide us the maximum amount of benefit for the amount of money that we're paying. So hopefully this clears up a little of it. It's definitely not as simple as, say, homeowners insurance or vehicle insurance. There's a lot of different factors you can consider, and I just really touched on the very base options. There's other stuff that we can add into crop insurance that may or may not give us a benefit. Of course, all these extra options are going to cost. So this is just a very base level explanation of crop insurance. But anyway, I hope you found this video informative in how farmers can use crop insurance to minimize their risk, and also realize that your tax dollars that you pay that goes to subsidizing the federal crop insurance program, how it can really help ensure the security of our food supply here in the nation. No farmer likes to admit that he receives subsidies or whatever, but in reality, these subsidies that we get are really important in securing, a year after year supply of high quality food at a lower cost to the consumer. So in my opinion, that the consumers, the taxpayers, are actually getting their money's worth in these subsidies that are paid to help ensure that farmers remain in business when they have years where things happen that they absolutely cannot control, just depending on what happened in that year. I cannot control that we went
almost 45 days with hardly any rain, with most of those days having a temperature of 95 plus degrees that basically cooked my corn crop in the field. I've done everything I can to try and prepare my soils to still be able to grow a crop, but this year circumstances beyond my control could have really put a severe financial burden on remaining in business another year. But because of crop insurance, we will be able to remain in business another year and hopefully keep on producing the food and fiber that this country requires. But just know that these subsidies that are paid, these subsidies are going directly to the crop insurance company. The crop insurance is the one that's receiving these subsidies. The farmer's not receiving these subsidies. We're just all we're doing is just able to have the benefit of actually being able to afford this crop insurance that we need, because without the federal subsidies, it just would not make sense financially for us to purchase crop insurance, because it simply would not be affordable year in, year out for us to do that. It would take every bit of the small amount of margin of profit that we have just to pay on crop insurance, and there would be a good chance that we would never be able to draw any money on crop insurance, considering this is only going to be the third time in 17 or 18 years that I've drawn crop insurance. I hope you found this video informative, cleared up a little bit of understanding of how crop insurance works. And if you got any other questions about crop insurance, be sure to leave a comment down in the comment section below. I'll do my best to answer it. Anyway, guys, I appreciate all of y'all watching. Stay tuned. We'll be back with some harvest videos coming up soon.